Welcome to The Deep Dive, the show where we take a stack of challenging earnings calls and deliver the essential insights you need in minutes. Today, we are tearing into the fiscal Q1 2026 results for Unifi Inc, ticker UFI. This is a company in the middle of let's call it a high-stakes self-help turnaround.
It was a brutal quarter, to be charitable, for the period ending September 28th. Management, they laid out this detailed plan. It's all about restructuring and innovation.
But the market did not buy it.
Not at all. The stock closed down almost 6% the day of the call, and we've just seen this persistent selling pressure ever since. The tension is obvious, right? Investors want to see profits, not just promises.
Okay, so let's unpack that skepticism. We have to start with the grim reality of the numbers. Top line, net sales came in at $135.7 million.
Which was a decline, pretty steep one, of 7.9% year over year.
Now, that figure technically did nudge past the analyst consensus, but the story behind it is weak. It's all about customers pulling orders forward ahead of tariffs, and then, demand just fell off a cliff.
The revenue was soft, for sure. But the real structural pain, the thing that jumps off the page, is profitability.
Yeah.
GAAP diluted EPS was a big miss at -$0.62 per share. That's a net loss of, $11.4 million? Mm-hmm. Even if you adjust for all the transition costs, you're still looking at -$0.66.
But the number that really made me sit up, the most concerning figure in this whole report, has to be the gross margin.
Oh, absolutely.
It just compressed so severely, falling to a stunningly low 2.5%.
2.5%. That's down from 6.4% in the prior year. That is a nearly 400 basis point drop.
So how much of that collapse was, unavoidable chaos from the restructuring versus just weak underlying volume?
Well, management would tell you it's both. It's the pressure of lower volume running through the plants, so you're not absorbing your fixed costs, plus all those specific temporary restructuring costs.
When your gross margin is 2.5%, you're functionally operating at a loss before you even think about SG&A.
Exactly. And that's reflected in the adjusted EBITDA. It swung sharply negative to -$2.5 million. Just a massive drop from a positive $3.3 million in the same quarter last year.
And this is all happening against a balance sheet that is already, let's say, stressed. Net debt is up to almost $100 million.
$99.8 million, yeah. Wow. Up from about $85 million at the end of the last fiscal year. They are highly leveraged.
Which just makes the margin pressure and the need for, flawless execution in the next 2 quarters absolutely critical.
It's critical. The debt forces their hand. They don't just have to deliver a turnaround, they have to deliver it now, which is why they spent so much of the call explaining the quarter, pointing to 2 main obstacles.
Okay, one external, one internal.
Exactly. One hitting demand, the other hitting their own costs.
So let's start with that external one, the tariff shock. Management described a classic supply chain distortion here. New tariffs hit in April. Customers rushed to place orders to beat the price hikes.
Right. They pulled all that demand forward. And since then, orders have been, and I'm quoting management here, extremely light.
Extremely light.
It's hitting them everywhere, but especially in Asia and Central America.
Yeah.
The result is they are in this sort of demand air pocket right now. They think it's going to last through Q2.
So they're not expecting orders to normalize until, early 2026?
Early calendar 2026, which is their fiscal Q3. And for a leveraged company, that wait feels like an eternity.
It does. Okay, now the second obstacle. This is the one they claim is already fixed. The internal operational friction. This came from closing their Madison, North Carolina facility and moving all that production over to the Yadkinville plant. That's what created all the short-term inefficiency and costs.
Right. The $1.1 million in transition costs we mentioned. That's the management pitch. They're saying that noise is gone. They were emphatic, saying these costs are now fully complete.
And they have some proof.
Well, they cited positive operating results in October, the first month of Q2, as evidence that the immediate productivity hit is behind them.
I hear them saying it's fully complete, but the market is clearly not buying it. Isn't that $1.1 million cost pretty minor compared to proving you can find $5 million in sustainable savings every single quarter?
That is precisely the market's skepticism. The $1.1 million is the symptom. The disease they have to prove they've cured is the inability to integrate production efficiently.
Before we get to the cost cuts, did any part of the business show some strength?
Yes, actually. Really Preview, their sustainable fiber brand, that held up really well. It accounted for 29% of sales.
So that branded high-value stuff provides a bit of a buffer against the commodity side of the business.
It does. But then you look at Latin America, specifically Brazil, and you see other problems. Demand is strong there, but they're getting hit with what they call dumping from Asia, which is huge import pricing pressure.
So they're fighting headwinds on multiple fronts.
On all fronts.
Okay, let's pivot to the forward-looking story then. It's built entirely on this turnaround strategy, resizing the company and innovating.
They were very clear. The goal is to resize the operating cost model to fit this new level of revenue. And they have been aggressive.
Right. They sold the Madison plant for about $45 million.
And now there's a new cost reduction plan. This is the foundation of the whole story. They are targeting $5 million in quarterly manufacturing savings for the rest of fiscal 26.
$5 million a quarter. So that's $20 million annualized just from manufacturing. That is critical leverage against their fixed costs.
It's a huge operational lift.
Yeah.
And they're going after SG&A too, targeting another $4 million in cash savings this year. The goal is to get annual SG&A below $45 million.
So these cost cuts are the immediate answer. The idea is to make the company profitable even if revenue stays this low.
And their guidance hinges entirely on this. They're expecting sequential improvement in adjusted EBITDA and, this is the big one, positive operating cash flow starting in Q2.
Hitting that positive cash flow is the first step to dealing with that debt.
It is. Then they believe revenue growth comes back in Q3 once customers finally work through all that inventory they bought before the tariffs.
So what keeps this whole thing from just being a cost-cutting story? What's the growth narrative?
It's the strategic pivot they call Beyond Apparel. They're focusing on higher margin, value-added products that are less, cyclical than basic yarn.
This is crucial, right? It diversifies their risk.
It really does. And we're talking about some sophisticated stuff. They mentioned Fortisyn, which is a tactical yarn for military and defense, much higher margin. Also, A.M.Y, Peppermint odor-control yarn.
And Reprieve is moving beyond just textiles, isn't it?
Yeah, Reprieve polyester resin. They're targeting packaging, automotive components. This isn't just a dream either. They put a number on it. They want these Beyond Apparel initiatives to hit a $20 million annual run rate by the end of calendar 2026.
That's a material new revenue stream.
One other thing they kept coming back to in the Q&A was this sort of hidden strategic advantage they have with trade policy.
Oh, this is interesting. They're educating customers that if they use U.S. yarn in Central America, they can actually unlock tariff rebates.
Yes, it's a complex, but frankly vital mechanism. For listeners who aren't deep in this, can you explain why that's so powerful?
Sure. It leverages trade agreements like CAFTA-DR, which have what are called yarn forward rules. Basically, these rules incentivize North American sourcing.
So if you're a big apparel brand and you use yarn spun in the U.S. for your clothes being assembled in, say, El Salvador.
Right. Then that final product often qualifies for preferential duty treatment or even a full tariff rebate when it comes back into the U.S. It's a massive cost incentive for brands to nearshore their supply chains.
And UFI, as a domestic yarn provider, is perfectly positioned to capture that demand.
So despite all of this, the cost cuts, the innovation, this trade advantage, the stock is still trading near its 52-week low. What gives? Why is there so much skepticism?
Well, I see two big reasons. First, you have unavoidable technical selling pressure. The company was removed from the S&P Global BMI Index in September.
And that forces all the giant index funds that track that benchmark to just sell, regardless of fundamentals.
It's just a forced liquidation. So that's sustained, unavoidable downward pressure on the stock.
Okay, what's the second reason?
The second is simply the execution hurdle. They're asking you, the investor, to trust a management team that just reported a 2.5% gross margin with high debt to flawlessly implement $20 million in annualized savings.
While also navigating price wars in Brazil and tariff shocks in Asia?
It's a lot. The market is just waiting for cold, hard proof. They want to see that positive cash flow in the Q2 report.
Exactly. The street wants to see that $5 million in quarterly savings actually hit the income statement and see volumes really stabilize in Q3. Until then, it's just a high-risk story.
Which brings us to our final segment where we pitch the outrageous but plausible trade.
And let's be very clear.
This is not financial advice. This is purely for intellectual discussion. It's a way to explore how you might structure a trade around these ideas.
Okay, disclaimer delivered. Given everything we've talked about, the severe undervaluation, the aggressive cost cuts, the potential for a cash flow inflection point in Q2, this is the quintessential leveraged turnaround or bust play.
The outrageously plausible trade here is to initiate a high-conviction, long position. You are wagering entirely on management's ability to execute on the cost side.
You're betting that the $5 million in quarterly savings will combine with revenue normalizing in Q3 to create this massive non-linear jump in profitability. If they do it, the stock moves a lot higher.
A lot higher, but the downside risk is, as you said, massive. That $100 million in debt in a cyclical industry is no joke, so protection is key.
So how do you hedge this wild bet?
You hedge it by buying protective long-dated puts. But what's really fascinating here is the pricing. Around the time of the call, the implied put-to-call volatility ratio was near 1-to-1.
Okay, so a 1-to-1 ratio. Does that just mean the cost of betting on the stock's failure hasn't gone crazy yet? The market hasn't fully panicked?
Precisely. It's telling you that the market still sees the turnaround as a plausible outcome. Options volatility is relatively cheap. You are essentially buying insurance against a balance sheet failure at a reasonable price.
So it's a structured trade. You bet on the operational recovery and you buy cheap insurance in case the whole thing goes bust.
That's the idea.
Okay, to wrap this up, UFI's Q1 absorbed a ton of pain, both from external trade shocks and internal friction. The focus for investors is now entirely on Q2 and Q3.
They have to prove the cost structure is truly right-sized and that this demand air pocket is actually normalizing. The path ahead is tough, no doubt, but the reward for a successful turnaround is substantial.
Which leaves us with a final thought for you, the listener, to consider.
Management kept highlighting how using U.S. yarn unlocks tariff rebates for their Central American customers. Now, given the macro shift away from Asia, the global push for nearshoring, could this technical, tariff-driven complexity, the very thing that caused all this near-term pain, actually become the long-term structural advantage that lets UFI sustain higher margins in the Americas?
Something to chew on as they head into Q2. That's all the time we have for this deep dive into UFI's latest quarter. Thank you for tuning in.